has become quite common for me to start by saying we live in very interesting times. And it's certainly a euphemism if you look at what happened to financial markets since the beginning of the year and the volatility that we've experienced between the various asset classes and even within the asset classes. And maybe it would just be good to revisit the performance of the various asset classes to understand how the macro environment had an impact on investor sentiment and how investors assessed the various asset classes. So let's start with equities. We've said in the previous quarter and certainly at the beginning of the year that it would not be uncommon to find that the markets respond in a very barbell fashion. What does it mean? It simply means within a particular asset class, some assets do particularly well and other assets are very uncorrelated in the way that they respond to the very strong performance by underperforming. And maybe we can just give a few examples to illustrate that point. If you look at the performance of the Nasdaq, which is in essence American IT shares, the Nasdaq is up by 35% year to date. On the contrary, what we've seen is that financial shares listed on the S&P or part of the S&P 500 index, those financial shares are down 25% in dollar terms. So there's a gap of 60% between the best performing sector and one of the poorer performing sectors. And it's not only true for international shares. We've had exactly the same experience within South Africa, where the so-called South African Inc. shares, those are the shares that are predominantly make their profits within the South African economy, they've underperformed severely in this COVID-19 environment. On the other hand, what we've seen is that the so-called low-risk stocks like gold, platinum, and also Naspers, which predominantly has been driven by the strong performance of Tencent, those shares have performed exceptionally well. In fact, if you look at it to the end of June, gold shares were up by 100% over the 6-month period, compared to very, very big negative performance of those so-called SA Inc. shares. In this risk-off environment, over the last 9 months, we've also seen that the rand has performed poorly. We have also seen that other emerging market stocks and currencies performed poorly, and most of the risk-off assets, like global government bonds, did quite well over this period. So in short, this very big divergence or disparity in performance of various assets and asset classes made for very, very interesting investment environment. And depending on how you position the portfolio, the investment outcome or the investment performance outcome would look very differently depending on where you had your money invested. And maybe I should just briefly talk about our positioning. As you all know by now, price is quite important to us, and it's not that we ignore the investment thesis or the investment story associated with an asset class or with a particular asset. But for us, margin of safety normally lies in the price. So we preferred the so-called cheaper stocks, which did not work well in the first 9 months. Having said that, before I create the impression that the performance was really poor, we more or less stayed in touch in terms of local equities with the all-share index, where gold and platinum and of course Naspers had a major impact on the total performance. We still stayed in touch with that performance, but we did not outperform. However, when we position portfolios, I think it's also important for clients to understand that the history is the history, and history is not necessarily a good indicator of future performance. It is important that you understand that when we position portfolio, it is for the prospective outcome or the prospective returns that we would like to generate. And that might mean that in the short term, the performance might lag. And that is exactly what we've seen. The question is, though, within this environment where macro uncertainty is still rife, where we've seen a significant recovery in economic activity, but you can see it is starting to lose momentum internationally, where in South Africa we've also seen a big jump in economic activity, but there's still an enormous amount of policy uncertainty within this environment. At what point do we think somebody will trigger a change in investment sentiment that will bring these unloved stocks and unloved asset classes back into play and make them work for our clients' portfolios. Now, at the time when we did this recording, I think we've just seen the first signs of a potential trigger or catalyst, as investors like to refer to, that might bring a change in the environment. What might that be? Very difficult to forecast those. But we've had initial indications that medical companies or pharmaceutical companies are quite far down the road to bring a vaccine to the market that will have an impact on COVID-19, the cases, and the remedy to the issue. Remember that the decline in financial markets was largely a result of medical issues, not financial issues. So if we want a solution to market problems or a solution to poor investor sentiment, we need a medical solution to change the sentiment of investors. And we have seen a bit of that on the 10th of November when we got the news that Pfizer is very close to launching a vaccine and that the test has been very favorable. What was the result of that? We've had a massive reversal in the performance of the loved stocks that came under pressure and the unloved stocks that performed exceptionally well. Just on the day, on the 10th of November, the Sasol's share price, which was one of the big detractors from performance in our portfolios, gained 25% in one day. But we've also seen that international banks that were also laggards as I introduced the topic, on average gained about 14-15% on the day. Now that doesn't mean to say that that is the start of a new trend, but I think it is important to say that at least those investors who back the story started to understand how dangerous it might be to ignore valuations. So we still believe that the actions that we have taken during this year, where initially when we started the year we had quite a conservative approach to asset allocation. We started to favor SA Inc. shares in our equity portfolios. We didn't hold any property stocks in our equity portfolios, very low exposure to property stocks. That positioning was the correct positioning to start of the year. When the market sold off, of course, we added to risk in the portfolio during April, and we added a lot of the so-called unloved stocks, which haven't worked up until now. But in the last 2-3 days, it has worked particularly well for our client portfolios. Going forward, if we can just quickly summarize our views on the outlook, I think what we've seen in the third quarter is that most of the economic indicators that came out more or less match expectations of the market. But as we moved into the fourth quarter, it became quite clear that we are starting to see more and more negative surprises in terms of macroeconomic indicators. And that actually sits very nicely with the view that because COVID cases started to pick up again, that the restrictions imposed on economic freedom is starting to have an impact on economic activity again. So it wouldn't surprise us to see a few negative surprises going into the fourth quarter, and in all likelihood, GDP growth in the world will probably be roughly somewhere between -2.5% and -3% for the year. Into next year, we think that the stimulus that economic authorities provided to the macro picture, that stimulus should work, and we should see a continuation of the recovery that we've seen that started back in the second quarter of this year. From a South African perspective, it's very tough to forecast. The one thing that we can say, if we analyze most of the high-frequency economic numbers that came out, that just as we've seen a decent recovery in the world, we are starting to witness a decent recovery in South Africa in economic activity. However, from a longer-term perspective, I think the same question marks remain. There's still big policy uncertainty when investors evaluate or assess the macroeconomic situation in South Africa. We still sit with a major fiscal issue where the solution is very uncertain and it will take time to work that away. However, what we do know and we've said that a quarter ago as well, is that South African equities remain cheap for us in terms of their own history, relative to interest rates, relative to inflation expectations, and certainly also relative to the valuations that we've seen from overseas equities. So how does that play out? We maintain our position within equities where we favor SA Inc. shares, but it's not a binary positioning that we apply in our portfolios. We still have stalwarts like Naspers in the portfolio. We still have stalwarts like Anglo American in the portfolio. But we just blend it with what we believe shares that are quite attractively priced. From an asset allocation perspective, we've moved the equity exposure to what we call neutral. And in South Africa, of course, slightly higher in equities. Neutral means that we've positioned the portfolios halfway between what we believe is overweight and underweight. So it is quite a conservative position. Should markets drop, we've got the ability to buy more shares. And should markets continue to run, then we can take profits in those shares that do particularly well. We were also, let's call it, brave enough to use the opportunity when South African bonds sold off. In other words, when local bond yields went significantly higher, we used the opportunity to acquire government bonds for the portfolios of our clients. Given the recent change in investor sentiment, we've seen those yields come off significantly, and we have seen the benefit of that in our portfolios. Should that trend continue at some point, again, we will take profits and then re-employ the money in areas where we think there's better value to be had. So I want to summarize. It was an extremely eventful 10 or 9 months that we've experienced. It was also a 10 or 9 month period where the volatility was massive. But I think if we look back, at least we can say that by and large we've used the opportunities that was on offer in the market, that some of those opportunities did not play itself out in terms of big positive performance in our client portfolios, but that the recent change in investor sentiment, if that can be sustained, I think our clients can look forward to very competitive investment performance from our portfolios.